Welcome to Herb W. Morgan's Slaying Bulls and Bears, a podcast about economics, markets, investing, politics, and profit. Every Monday, in less than 20 minutes, Wall Street portfolio manager Herb W. Morgan distills the complex and complicated into the simple and sensical. Here's Herb now.
Morning. It's Monday, June 24th, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer, Cantor Fitzgerald Managed ETF Portfolios. This is my weekly market and economic commentary for the week beginning today. You can follow me here on the YouTube channel, Slaying Bulls and Bears, or if something relevant happens during the week, I try not to post too often, but I will post commentary on either X or LinkedIn. Actually, on both will be posted there. The presentation you're seeing and hearing has been prepared by us for use with you, whether you are a financial advisor or an individual investor. Either way, you're expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment advice. There's no tax advice, no recommendations for the purchase or sale of any securities. Everything is strictly for informational purposes only. The views expressed herein are mine and mine alone and may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Well, let's get into it. We had a great week, quite frankly, in equities. Again, interesting outperformance by mid-cap. Okay, fine. CSI 300, that's the Chinese Shenzhen 300 index, down 1%. But equities across the board continue to hold the bid. This is at a time when even bulls like us, we've been bullish for quite a long time now, led by our belief in the U.S., in large cap, in technology. All of that continues, and so a lot of bulls have been skeptical lately. Like, hey, we're due for a correction, we're due for a pause, a pullback, and yet it just seems to keep powering on. Fixed income down a little bit as measured by the aggregate bond index last week, as except not high yield. High yield's correlated to equity. The longer dated treasuries down as rates kicked up a little bit there. And you can see the ag back into red territory for the year. Long dated treasuries down 3%. Interesting, prior at the beginning of the year, everybody was expecting all these rate cuts and, so many rate cuts so fast, which, you would think would have had a higher return for long-dated fixed income. Not the case, as rate cuts have continued to get pushed back further and further. As you know, my view is it is the Fed's November 7th meeting for the first rate cut, barring any major developments between now and then, as they want to maintain their appearance of independence. And so they will wait till 2 days after the U.S. election. Let's get into economic data from last week, starting with retail sales for the month of May. They were up 0.1%. That was well below the estimate of 0.3% after falling in April. We're starting to see some disinflationary pressure, if you want to call it that, or some moderation in retail sales. That's good for the Fed's fight, obviously, against inflation and capacity in the economy, et cetera. Moving on to manufacturing from the New York region, the Empire State Manufacturing Survey rose from minus 15.6. I should say it improved from minus 15.6 to minus 6. Anything below zero says that manufacturing was lower than the month before in the New York region. New orders lower, but not by as much as the previous month. Employment lower, significantly lower, minus 8.7. However, respondents' 6-month outlook and view seem to improve. On a national basis, moving from the New York region to industrial production capacity utilization for the country, they say industrial production gained 0.9, which was 3 times the expected number, following a note change, or an unch, as we call it, in April. And utilization of our nation's factories rose from 78.2 to 78.7, a little bit above estimates. One of the gauges I look at for inflationary pressure is capacity utilization. That's the red line. I'm going to go through it here with this little red dot. When you start getting to 80 or poking through 80, traditionally that is signs of, okay, the economy's overheating, you've got this inflation. And as you can see, it's been really steadily coming down since being above 80, along with inflation. It's correlated quite well. Inflation has moderated significantly. We talked kind of in depth last week, so I won't go there. But this was a little tick up, nothing to be particularly concerned about at the moment. The other thing that's shown that little tick up is initial claims for unemployment. This is first-time filings for unemployment. It's a weekly report, comes out every Thursday morning, 5:30 a.m. my time, Pacific Standard Time. And weekly initial jobless claims came in at 238, down a tad from the week before. That's a low number. It's a healthy number. It's a good number. It's just higher than it's been. It's been down at this 200,000 line. You can see that poked up last summer before coming back down. We're poking back up again. Definitely not ready for the Fed to say, oh, we've got to do something about our other mandate, which is fostering full employment. Although we did tick up from 3.9 to 4.0 on the last monthly report from the Bureau of Labor Statistics. And if we go even a tick higher, 4.1 to 4.2, 2 ticks higher, then I think the Fed could potentially pull forward those rate cuts. The problem is they have to also be looking with the other eye at the inflation number, and that has to be continuing to improve like it did in last month's report. We got a fair amount of data last week on the housing, and housing is important to all of us. It's important because we own them, and we're concerned about our own personal balance sheets, of course, and that has a spending effect and an impact on the economy and a GDP effect and an employment effect, all of these things. But it's also important for those people who are, new household formations that maybe don't own their home yet, their home. And so pricing matters, capacity matters. The National Association of Home Builders Industry Trade Group has an index that when it's at 50, above 50, it says that home builders are generally optimistic and feeling good about their profits and their viability and their ability to employ people. When it's below 50, the opposite is true. So it fell from 45 below 50 to 43, more below 50, and below the estimate of 46. So home builders, particularly negatively impacted by the increases in short-term rates that we've been living with now for a couple of years. Well, why? Well, to build homes, you need to borrow money. You need to have lines of credit, construction loans, financing, hold those homes in inventory, and then sell those homes. Well, there's uncertainty about how much people can afford, given the higher rates, given the inflation that's impacted everything from lumber to appliances to cabinets to flooring to labor. All of that has conspired to say that the home builders and the home building industry and everything associated with it, from realtors to title people to insurance people to the trades, they are the most impacted by these movements in interest rates. And clearly the sentiment there has turned significantly negative. Along with that, starts and permits also turning down. Peak back here in 2021, pretty high numbers, well above 1.5, 1.6, 1.7. Housing starts for May fell 5.5% annualized. Single family 5.2, multifamily was down further at 6.6. Permits dropping as well. You can see this number has been trending down. Very good inverse correlation with the direction of the Fed funds rate during that period. Now, I showed you New York State manufacturing. We're going to move now to Philadelphia region. They're obviously very, very close to each other, but the Philly Fed Business Outlook Survey fell from 4.5, that is above zero, that's positive, to 1.3, also above zero, positive. So a little bit better in Philadelphia than we're seeing in New York. New orders improved but remain negative. In other words, they dropped month over month, but they dropped at a very small rate compared to the prior month drop, which is a very big rate. Same thing can be said about employment. The overall general outlook is still, for 6 months out, a year out, is okay, but not great. Okay. Then we got the flash readings, which is the readings that come out for the month before the month ends, to give you an idea what the reading might be the next week after the month end, which is called the final reading. We almost get too much data. But, of course, I love data. I love just talking about the data, giving it to you, making it simple and sensible to the extent that we can. The S&P Global Manufacturing PMI for the United States. It's not a global PMI, it's for the United States. Above 50 says manufacturing expanded. And if you look at this, manufacturing is about 15% of the U.S. economy. Here's a couple of years going back to, this goes back to 21, but a lot of time below 50 and contraction after the big COVID reopening, expansion of manufacturing. Couple of months above 50. This month above 50 came in at 51.7, above estimates. That's certainly a positive sign, not for those that are sort of hoping for more disinflation, but for those that are hoping for more employment and economic growth and economic activity. Coming in above 50 is a positive. Service side of the economy, roughly 85% of the U.S. economy from the same company, S&P Global, for the preliminary reading for the month of June, accelerated to 55.1, above expectations, above the prior month, really highest reading going back all the way to 22. So while you have some data sort of pointing to, hey, we're really close, teetering on a recession, there's other data like this that says not just the opposite. We could be reaccelerating here. And the question is, can we reaccelerate without also reaccelerating inflation? Demand is strong. We've talked about, if you step way back, I see a lot of this coming from the Tax Cut and Jobs Act of 2017, which inspired capital formation, which inspired employment, which inspired profitability, economic expansion. It was a very pro-investment, pro-GDP growth set of tax codes. There was some add to deficit stuff, which I'm not a fan of, but it was consequential. And this is scheduled to, most of the provisions of the Tax Cut and Jobs Act of 2017 are scheduled to expire at the end of 25, with a few more expiring at the end of 2026. And the thought of all of this going away, when is that going to start impacting valuations in the equity markets? We're 18 months away from some of these very significant expirations, and we have a big election in between. Back to real estate for a second, talking about existing home sales for the month of May. They fell 0.7, a little better than expected, down 2.8% year over year. The volume level annualized of units just over 4 million. You can see back here in the heyday of basically zero interest rates, 50%, more than 50% higher at 6.5 million. Again, I already told you about this. This is tip of the spear stuff, and we move on. So I showed you something that shows, hey, the S&P Global Manufacturing Survey kind of poked up. The services survey is kind of poking up, suggesting the economy may be really reaccelerating, but completely conflicting data suggests it could be decelerating. Maybe this makes it Goldilocks. I don't know. But the Conference Board puts out a leading economic index, LEI, which takes data, compiles it, and says, hey, this is predictive of where the economy may be heading. And when that index turns lower, you can see this is going back to 2000, so this is this century. When it turns lower, it usually precedes the onset of a recession. There's the 2001 recession. Ultimately, the index dropped 11%. You can see the 2008-2009 recession, and here the index dropped about 27%. The COVID supply side recession, the index dropped about 11%. And so far this cycle, the index is down about 15%. Does that mean necessarily that it is predicting and preceding a recession? Well, of course, everything I did today is preceding a recession, assuming we're going to have another one someday, obviously. How great of an indicator is it? I'll let you be the judge. I think it's one to continue to watch. It's an important and it's a valuable one, but it can easily, potentially turn higher without ultimately having the onset of a recession. Now, I talked to you a little bit last week about how this bull market that we've been in for some time has been all about large cap stocks. The biggest companies in the world happen to be headquartered in the United States. The index, the S&P 500 or the NASDAQ 100 or any of these are heavily weighted towards very large technology companies. And as such, the performance of mid-cap stocks, international stocks, small stocks has lagged very significantly behind for a very significant period of time. And for those investors like us who said, let's be overweight the US or overweight large cap US or overweight technology, it's been a great run for a number of years. So it's logical to ask the question, well, is it over? Is it nearing an end? Are we late in the cycle? Are we early in the cycle? Will this cycle go on for another 5 years? Will go on for another 10 years? Nobody knows for sure, but we can look at the data and we can sort of come to some conclusions. So let me talk about this graph. This is the price to earnings multiple of the S&P 500 and juxtaposed with the price to earnings multiple of the S&P 600. Now the 500 are the 500 large names and the 600 are domestic small cap names. So the two PE multiples right now, as you can see, 25.6 on the S&P 500, but only 16 times earnings for the S&P 600. So that gap, that's the green gap down here, is 9 full multiple percentage points. So clearly small companies are cheaper. Now, throughout my academic time and my professional time, we've always said small caps are more volatile and over time will outperform because they can grow faster and grow more. It just hasn't been the case for some time, and so they've gotten really cheap. When was the last time they were this cheap? Well, I'm going to move my little red dot down over here on the left all the way to the 1999. Remember the 1999 dot-com stock market bubble, big cap names, tech names, small names, every kind of name. And that was the last time the delta or the difference in valuation was this big. So we move to the next chart. Let's just talk about performance just through Friday. And then I'm going to go to another graph here, or another, what do you call this, Excel sheet, a sheet that shows a story from 1999. So from 1 year through Friday, S&P 26, S&P 500 26, 600 small names only 10. 3 year period, 35 versus negative. 5 year, you can see 100% versus 50%, let's call it. 10 years, 600 versus almost 500, 20 years. So over the last 1, 3, 5, and 10, especially, the difference has been large cap. That's been the name of the game. But what happened late 1999, right? Remember, late 1999, we had this same kind of valuation differential that we have today. Actually, it was even slightly more exaggerated, and it was there for kind of a couple of years. Now, if we go back to 1999, and I'm just picking June 30th because it's the middle of the year. I didn't check if May or April or anything was better or different. I just picked June 30th. At the time when that valuation was so different between small cap stocks and mid cap stocks, the S&P 600 being small, the S&P 500 being large. And so when that difference was there, what happened 1 year later? Well, S&P 500 still outperformed. But then you look at a 3-year number. Look at that 3-year differential. Small cap stocks really did better. 5 year they did better. 10 years and 20 years they did better. So the question for investors now, we're asking ourselves, is it time to think about making a slow transition, not out of, but sort of that allocation towards small cap, which has been very underrepresented in our portfolios, successfully underrepresented for a period of time? Is it time to start looking at domestic small cap stocks? And it's a discussion, investment committees all over the world are having, including ours here at Cantor Managed ETF Portfolios. In terms of economic data this week, today, Monday, nothing major schedule. We've got home price data from FHFA and Case-Shiller tomorrow on Tuesday, along with consumer confidence. Wednesday, new home sales, regular initial claims. On Thursday, Q1 GDP, interesting, expected to see a tick up by 0.1%. Durable goods, pending home, income spending, PCE, major one. Look at the consensus estimate. Remember I told you last week, we had some sub data within the CPI and the PPI that tells me, hey, this fight's kind of over. Fed won't say it publicly. They need more data, more months. They don't want to appear to be influencing the election in any way, but they know, what I see, we all see. I think this inflation story is beginning to slowly, it will now begin to slowly fade away. Chicago PMI and consumer sentiment all on Friday. Available this as Slaying Bulls and Bears on the YouTube channel with Herb Morgan, myself. Also audio only on any podcast format. Thank you. I'll be back to you again 1 week from.
Thank you for listening to Slaying Bulls and Bears. If you'd like to download the slides for this week's podcast, go to www.efficient-portfolios.com and join our mailing list. Don't forget to subscribe to our YouTube channel, rate us online, and share with a friend if you found this helpful. See you next week.